Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I am Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. It's a real pleasure today to welcome back Ben Gordon to our podcast for the third time. Ben is the founder of BGSA Holdings as well as Cambridge Capital, both located in Palm Beach, Florida. Ben draws on a career spent investing in, advising, and building supply chain and technology companies. At BGSA Holdings, he has led the firm's efforts, advising on more than $1 billion worth of supply chain transactions. He's worked with firms like UPS, DHL, Kuhn & Nagel, Agility Logistics, NFI Logistics, Genco, Nations Express, Raytrans, Echo Global, Dixie, Wilpac, and many others. Prior to BGSA Holdings, Ben founded 3PLX, the internet solution enabling third-party logistics companies to automate their business. He raised $28 million for the company from blue-chip investors, including Morgan Stanley, Goldman Sachs, Bank Boston Ventures, CNF, and Ionian. 3PLX was then purchased by Maersk. Prior to 3PLX, Ben also served transportation and logistics clients at Mercer Management Consulting. And prior to Mercer, he worked in his family's transportation business, AMI, where he helped the company expand its logistics operations. Ben holds an MBA from Harvard Business School, as well as a Bachelor of Arts from Yale College. Ben, welcome back.
Jeff, thank you. After listening to all those great things, I should just let you do the talking.
Well, people can get tired of me pretty quickly sometimes, so we'll just get rolling here. Ben, I know we've had a lot of conversations over the years, and given the M&A activity is really the sweet spot of your companies that you oversee and lead, why don't you just tell us a little bit, if you will, please, about sort of the current state of freight transportation slash supply chain slash logistics M&A activity at the moment, early into 2024, that is, with Q1 almost complete.
Glad to do that, Jeff. Well, first of all, I think we've been through a tumultuous 4 years. During COVID, I think coming into COVID, there was a lot of nervousness, anxiety. People didn't know what to expect. And in the beginning of 2020, everything was on pause. Then after it became clear that there was a surge in growth in e-commerce and work from home, and a lot of the supply chain companies were beneficiaries of those shifts, and the shortages led to spikes in everything from transportation spend to inventory buildup and warehousing ripple effects and others. And that, of course, led to a surge in growth, particularly for e-commerce logistics companies, which fueled a surge in valuations and M&A activity and financing activity in 21 and 22. Then we had the great freight crash of 23, really February 22 through just about the present. We've seen freight rates decline by approximately 50%, and that has led to a plunge in profit as well as M&A activity for companies in many areas of logistics. We're now just starting to see things return to at least the early innings of a return to normalcy. So we're seeing pricing has seemed to hit some stability. Freight rates are starting to tick up, although there was might have been a false spring in January and then a return to winter in February, but things seem to be starting to get back. And that in turn has encouraged buyers to start to get more aggressive. Also, sellers who had, I think, artificially high expectations after the spike of COVID, 2021, 2022, buyers have started to come to the recognition that that was a one-time event and that the realistic expectations look more like they did pre-COVID than during COVID. And so one, you have a return to or steps towards a return to normalcy in the markets. And two, you also have some psychological adjustment, both on buyer and seller mentalities, that's leading to a little bit more equilibrium. And so for all those reasons, after a year when very little got done from an M&A standpoint last year, I think we're going to see a busy 24.
Yeah, that's great. So, and I know you had mentioned e-commerce as sort of a COVID byproduct a moment ago, Ben. Um, in respect to things like e-commerce and last mile, are you seeing those deals still occurring with perhaps not with the same type of frequency as before, but do you still see those deals happening? And as a follow-up, what other verticals or what other areas are sort of gaining or driving interest? I couldn't help but think of the recent GXO Wincanton announcement a week or two ago, as an example. But I'm just wondering what segments you're seeing activity or at least the beginning of activity.
Yeah, so Jeff, the GXO Wincanton deal is a good illustration of a back to basics kind of a deal. That's a good old-fashioned consolidation. GXO, of course, originally part of XPO, which is one of the great consolidation stories of all time. You
Yes.
know, from 2011 to 2017, XPO bought approximately 20 companies, and meanwhile, their market value surged from really de minimis to a $20 billion company. If you were a shareholder, if you invested with Brad Jacobs in 2011, as we did, you would have made a 50x return on your investment over the course of a decade. And so that surge in growth was partly fueled by acquisitions. And after GXO spun out of XPO, they have returned to the M&A markets, and the Wincanton deal is a good illustration of that. Really, what Wincanton gives GXO is the ability to boost their market penetration in Europe, particularly strong in the UK, but continental Europe as well, in contract warehousing and logistics, as well as other value-added services. And so it's really doubling down on something that GXO already does. So that's why I say that's a return to classic consolidation. So I think we'll see more of that. The second question that you asked was about the e-commerce side, and I do think we'll see more M&A activity in e-commerce logistics. Now, in 21, we saw a tremendous level of M&A activity and surge in value. We saw 5 e-commerce fulfillment companies become unicorns around the 2020, 2021 timeframe:
Hmm.
ShipBob, ShipMonk, Flex, Deliver, Stored. And you know, those companies achieved growth partly because there was demand for e-commerce fulfillment because of the surge in e-commerce, and partly because they did a very good job of focusing on that arena, but also because the market was willing to put higher multiples than had been historically the case on those kinds of businesses. And in fact, not only were supply chain software companies getting multiples that in some cases were over 30 times, but tech-enabled services companies like the ones I mentioned were also getting those kinds of very high valuations. I don't think we're likely to see too many of those 30x plus revenue multiple deals anymore, particularly for tech-enabled services. But I do think there's strategic merit in e-commerce logistics companies selling to other people that are looking to serve that market. And therefore, for good strategic buyers that can gain synergies, whether that's because they're cross-selling because they could bundle more capabilities under one roof, or maybe they're more of a traditional logistics company that are looking to add a tech-enabled capability, or maybe it's a company that's strong in the US that wants to get into Europe or vice versa, and it becomes a geographic expansion. Those kinds of deals will still produce synergies, create value, and will get done. And so it's really just a question of, is there a market clearing price that everybody can agree on? And like I said, maybe it's not going to be, you know, a 30 times revenue deal for a company like that. But look, it's still the case that if you can create value for customers, you'll do it.
Yeah, no, that's a great point. Sort of speaks to what we've talked about over the years too, Ben, in regards to your work, your ongoing thesis of service convergence. And I just, I know I probably ask you this every time we have you on, but does service convergence, in your opinion, Ben, remain alive and well in the M&A space? And I guess would the same also apply to tuck-in type of deals?
Yes. So where are we seeing convergence? We see in a couple of different types of areas. One area of convergence is a company that's in warehousing and wants to add last mile. That's a very likely combination because if you are doing e-commerce fulfillment, you don't just want to be able to do what's in the warehouse and pick, pack, and ship, but you'd also like to control what happens either before or after the fact. So before the fact would be controlling your inbound logistics. After the fact would be controlling the last mile from your facility to the customer, whether that's to a retailer or to direct to home. So warehousing plus last mile is a combination that I think we will see a lot more of. I think a second area of convergence is the combination of freight forwarding and transportation management, like truck brokerage. So, and the idea is if you've got a shipment that's originating, China, India, Malaysia, and coming to the US, it's got to go through multiple steps. So there's a freight forwarding leg, but then there's ultimately a truck brokerage or surface transportation leg. Combining those is a logical capability. And then I think a third is, and this is particularly true in e-commerce, look, our private equity firm, Cambridge Capital, has 8 different portfolio companies in different areas of supply chain. 4 of them are in e-commerce logistics, and they're in areas that are adjacent to one another. So for example, Bird is e-commerce fulfillment in Europe. Bring is last mile software as a service, US and worldwide. Parcel Perform is post-purchase tracking and visibility after you make purchase. And Reverse Logics is software for returns. You buy something and it's the wrong size or color, what's got to happen? Now, those 4 companies all do things that are adjacent with one another. That doesn't mean that we're going to merge them or combine them, but it does mean that there are synergies between companies that provide those types of capabilities. And so it wouldn't be surprising if at some point this year, somebody in the e-commerce logistics arena that's adjacent to those, 4 categories would look to buy one of those companies or more and combine them because it just makes sense. They're adjacent to one another.
Okay, that's really interesting. I was kind of curious, Ben. There's been a lot of attention given to how Mexico is now the United States #1 trading partner. And it's just interesting because I was wondering how you think that applies to the ongoing nearshoring thesis, and by extension, what potential impact that could have for M&A. For example, do you think we'll see more US-based companies actively looking to acquire perhaps warehousing outfits in Mexico, or brokerages, or small carriers, or what have you? Is that something that you guys are monitoring or keeping an eye on?
Yes. So in the last year, Mexico supplanted China to become the US biggest trade partner. And I think that's only going to continue. It'll continue for all the obvious reasons and then some less obvious ones. Obvious reasons, the fact that China has emerged as a clear threat to the US and that there's um, a strategic rationale for the US from a national security standpoint to build alternative supply chains. Then there's also the fact that manufacturing in Mexico should be a lot cheaper and quicker to transport from Mexico to the US than from China to the US. And then finally, you have companies that are increasingly making investments to strengthen their cross-border US-Mexico supply chains, and that creates a ripple effect. It's sort of like the network effect or clustering, where much like when a series of major tech companies set up shop in fruit orchards not far from San Francisco 60 plus years ago, it led to the beginning of what became Silicon Valley. Once you had a cluster of companies, that ecosystem supported more growth. Well, similarly, we're seeing a clustering of manufacturing in Mexico and cross-border US-Mexico supply chain. So yes, we see a lot of interest, a lot of activity, and a lot of opportunity in cross-border US-Mexico.
Okay.
And by the way, we're putting our money where our mouth is because, as you know, as you alluded to, we have 2 businesses. Our investment bank, BGSA, does lots of M&A, done over 50 M&A deals in the logistics and supply chain world. Our private equity affiliate, Cambridge Capital, invested in a Latin American tech-enabled logistics company called Lifted. And Lifted has operations in Mexico along with other markets. And we're seeing tremendous growth there. So I think not only is it something we believe in, but it's something that we're investing in.
Okay, terrific. I was looking, I was on I think I saw something you wrote. I think it was on LinkedIn or Twitter. I can't remember, but I'll just read it verbatim. It was really interesting, Ben. You had written smart shippers are investing in domestic transportation networks, and they are also expanding operations in the LA, Long Beach, area to create resilient supply chains. And after a record decline in freight rates, now is an ideal time for shippers to nourish your transportation relationships. It just kind of stuck out to me because in the near 20 years that I've been covering this industry, the topic of relationships, working together, collaboration has really been drilled and been a major theme, talking point, what have you, at nearly every conference I've attended. You hear it on earnings calls, you hear it just about everywhere. And looking at that in a few different parts, I mean, the need to create resilient supply chains really got heightened during the pandemic and obviously remains intact today. How are you seeing that? How are you seeing I guess the concept of supply chain resiliency come along, coupled with the nourishing of transportation relationships, that being between the provider and the customer being the shipper in this case, obviously.
Well, supply chain resilience is it's one of those classic topics that took on new meaning when we saw the disruptions of COVID. So
Mhm.
supply chain disruptions, um, like shortages, whether it was semiconductor chips or toilet paper or chicken or anything else, highlighted that if you ran too lean, you ran the risk of running out. And if you ran out, you could shut down your entire supply chain. So I think, in 2021, 2021, we saw the consequences of being overly dependent on long, extended, low-cost supply chains. And we saw the shift from just in time to just in case, where building up safety stock was a good way to protect against that risk of shortages and of running out. So I think since then, you've seen several things happen. One, you've seen retailers invest in building out their own infrastructure. And so that includes things like Home Depot and American Eagle and others buying their own transportation equipment, buying their own ships, uh,
Hmm.
building their own inventory, acquiring logistics companies, creating the kind of capacity so that they wouldn't be caught short-handed. Secondly, you saw people build up multiple sources of supply, the so-called China plus one strategy. If you used to source in China, then you added a plus one. Maybe it was Malaysia or Indonesia or India or Vietnam or somewhere else,
Hmm.
uh, which is now going from a China plus one to alternatives to China. A third shift that you've seen in terms of supply chain resiliency is, of course, building more inventory, which was good for warehousing for a period of time, and it meant that people built up more safety stock and conducted more warehousing business throughout North America. That may have run its course. We're now starting to see a slowdown on the warehousing side. So, I mean, this is a pendulum, and it may be that things now start to swing back in the other direction. But I think fundamentally, every retailer, consumer goods company, and shipper needs to be thinking about how do I build in resiliency? And one way to do that is to have more core supply chain relationships, whether that's with truck brokers or warehousing companies or supply chain technology companies or other. A second is to invest more in data and analytics. So, for example, one of the Cambridge Capital companies that's doing tremendously well is Greenscreens. Greenscreens
Hmm.
is the leader in AI-powered predictive pricing for trucking. So if you want to know what should it cost to ship a truckload of freight from Portland to Miami, you could go to legacy companies like a DAT, which would tell you what a market average price was. But typically that's a trailing indicator, like over the last month, not leading. And then secondly, it's a basket of market data that might or not be relevant to you and your origin destination pair. So what Greenscreens figured out was, one, they could use AI to be predictive, forward-looking, just like there's dynamic pricing in other parts of the economy, like airlines. If you bought a ticket to fly, uh, to to Vegas to go see the Super Bowl, you would have paid a lot more than if you were going a week earlier or a week later. That's dynamic pricing.
Yes.
Um, Trucking doesn't have that or didn't have that kind of dynamic pricing. Well, Greenscreens provides that. So you can be much more accurate right now as to what the price should be today and not a month ago. And then similarly, Greenscreens takes your data and can tell you what your OD pairs and things that are specific to your shipments would lead your own personal shipping costs to be likely to be. And so the combination of those two things, the predictive element and using your own data instead of general market data, has made for a much more accurate pricing and analytics tool. And that in turn has helped truck brokers save millions of dollars, and in some cases, tens of millions of dollars by just doing a better job of accurate pricing. And you could envision the same value for shippers, carriers, and everybody else in the supply chain ecosystem. So if you want resilience in your supply chain, having better data and better analytic partners is important. And green screens is certainly one way to achieve that.
Okay. Yeah, you can't understate the importance of good data, especially these days. Just a couple more real quick ones, Ben. Um, if COVID obviously created a ton of challenges. Then there were subsequent challenges where it was port congestion, and things like that, and in labor especially. Now things have shifted. Obviously, we're past that, but that doesn't mean we're out of the woods when it comes to challenges. I'm thinking of things like the Red Sea, um, the Red Sea issues, the Panama Canal issues, the Middle East. And obviously Ukraine too. And closer to home, we have things to worry about, like the the pending East Coast ports labor deal between the ILA and the USMX, which is come up. It's coming up at the end of September. Those are just a few I thought of. But what are some of the things that are on your radar when it comes to that really need close monitoring, a close and careful eye needs to be kept on as it relates to supply chain, both globally and domestically?
Well, I think three things. One, we lived through a lot of disruption in the last couple of years. There's plenty more disruption that could happen this year. One area that I would keep an eye on is whether we're going to have another port strike, and whether the ILA strikes in the northeastern ports, which could cause a shift in freight to the West Coast.
Yes.
And so that's one thing to look for, and certainly working with truck brokerage and freight management companies that can be more nimble, certainly one way to deal with that. I think that's one to keep an eye on. I think a second is political. If we nobody really knows what's going to happen in November, but
Right.
if we end up with which old guy that half the country hates will become president. But if it's Trump, he's already described his intent to apply higher tariffs, and imagine all the consequences that will have for tariffs, trade, and global supply chains, and it will probably A, be inflationary, and B, cause an increase in supply chain shifts to North America.
Hmm.
But that doesn't happen overnight. And so in the short run, if you're relying on sourcing from outside the US, which most, by definition, we're in a global supply chain, most companies do, that could get disrupted, and we could see a surge in costs. So that's something to keep an eye on. And then look, third is the pace of the recovery. So the freight recession, we saw a decline of about 50% in freight rates from Feb 22 through the present. Things are going to start to come back up. The question is when? Is it in another quarter or two? And by year end, as Chris Pickett says, will rates be up by another, I think, 15 to 20% or otherwise? And so smart shippers, I think, should be getting ahead of that by working with their carriers, their truck brokers, the freight management companies, recognizing that there's been an awful lot of margin squeezed out of the industry and record bankruptcies on the trucking side and the brokerage side last year. And now's a good time for shippers to start to invest in repairing and rebuilding those relationships, because otherwise they could be at risk of getting squeezed out when there's a tightening that will inevitably come over the course of this recovery from the freight recession. So I think those are three factors to keep an eye out for.
Okay, great. Well, listen, Ben, this brings us to the end of our allotted time for today's podcast. So, on behalf of Logistics Management Magazine, as well as the Peerless Media Supply Chain Group, I'd like to again say thanks a lot for joining us on the Logistics Management podcast series for what is now the third time. So the hat trick, really much appreciated.
My pleasure. Great to be with you as always, Jeff. Appreciate
Uh,
it.
Absolutely. Thank you. And then for those of you that are on Twitter, please go ahead and give Ben a follow. I promise you won't be disappointed. He's always putting out a lot of good content. And that's simply at Benjamin H. Gordon. And for those of you on LinkedIn, you can connect with Ben there. Simply linkedin.com/in/Ben Gordon 18, followed by another slash. And also, please go ahead and give us at Logistics Management a follow on Twitter. We are at Logistics MT. And also, if you're not already subscribed to the Supply Chain 24/7 podcast, please go ahead and do so. It's really easy. Just punch in Supply Chain 24/7 wherever you're getting your podcast, and it should pop right up. Thanks, everybody. Have a good day, and we'll talk to you real soon.